Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Khemani, Managing Director at Spectre.ai, the world's first brokerless trading platform enabling speculative trading on synthetic assets and crypto in a high-frequency, unlevered, and low-risk manner. Kay, it's great to have you with us. Welcome to Trade Talks. Thanks for having me. You got it. Tell us more about the Spectre.ai platform and how it combines decentralized and centralized protocols.
Right, what's interesting about Spectre is there's a myriad of CFD brokers out there, as you will know. You mentioned the two key points is that unlevered trading, but very high returns. And the second thing is the focus on risk management, right? So you have those two key factors that you will not find in other platforms. It's not just simple stop loss management, but it's actually looking at the trader's behavior and stopping them from blowing their accounts using some pretty advanced algorithms, right? So there's a deep focus on the risk management modules. And on top of that, of course, we're all about no leverage, right? And so you can generate between 70, 90, and even up to 400% returns, depending on volatility in the markets. But you can, of course, do this without leverage. And that's what really sets Spectre.ai apart from its competitors. Now, the thing to note is another factor where Spectre really stands out of competition is the decentralized aspect. So here, traders do not need to deposit capital with the broker, right? With the company that's actually offering the service. And that's pretty new. And the difference here is it's not just a DeFi protocol, right? Where you're trading against an unknown smart contract. It is, of course, only after KYC that you're allowed to do this at Spectre. But the key thing is in our decentralized wallet, you can actually trade against or have the market maker be completely decentralized. And when you win a trade, you get paid by the market maker. And if you lose a trade, your money goes to the market maker with a small fee being extracted to the service provider, right? And this is actually done without your traditional centralized intermediaries. And as you mentioned, there's also a centralized aspect for traders that don't want to trade decentralized. We also allow that.
So explain this to me a little bit more in depth. Traditionally, you would need to deposit assets with a broker. That's right. How they control their risk on their end. So exactly. Are they taking any risk by having it decentralized? How would that work?
That's a very good question. So firstly, what the algorithm does is it attempts to match your trade by another trader. So if you're going long the euro, let's say, or the Bitcoin for the next 60 seconds or for the next 2 hours, it will attempt to match you with another trader going short with a similar amount, right? So that, of course, depends on trader availability in the markets, liquidity in the markets. If it can't match you perfectly, that's when the market maker steps in and then the market maker takes risk. The difference here is that the market maker, which itself is a multi-million-dollar liquidity pool, isn't actually owned by a management team per se. There's no access to the fund, so to put it. So it does take on risk, right? But ultimately, as we see in trading, is that only 5% to 10% of traders actually who put in the know-how and the work and the discipline, they make money over time. So the market maker, generally speaking, over time, does make money. It does take on risk as well, right? And it does experience drawdown, but it's autonomous. And that's the key here. Whereas historically, it's been actively managed by very aggressive broker strategies.
So in theory, you should be, if I'm buying Apple stock and you're selling it, I could trade directly with you. I wouldn't need a middle person in between, assuming that we're in agreement on size and price and all that.
Exactly. You would normally go through the exchanges, as you know, and there's nothing wrong with that. I mean, you know, the top brokerages provide that in a very safe way with custody, with settlement, and that's perfectly fine. But when it comes to CFDs, with CFDs, you're not actually owning the underlying asset. You never own Apple, right? You will receive the equivalent of the dividends Apple may pay in the form of an increase in your P&L, right? But you never actually own the underlying asset, and you don't own the underlying asset in Spectre.ai as well, right? You're basically taking a directional trade. So it is a derivative, but the key thing to note is that, yes, you can do this now directly with another user. Normally CFDs, you're trading B-book directly against the broker. And so that really sets Spectre.ai apart.
That's really interesting. Thank you for mapping that out for us. Are you seeing a shift in favor of centralized financial processes at all?
Well, actually it's a shift towards more decentralized processes, depending on which part of the industry you are at. Yes, even within crypto, even within DeFi, there has been growth in centralized exchanges because they are becoming more regulated, and therefore they also bring more safety, right? And the space is getting more mature. So yes and no, in answer to your question, depending on which part of the industry you're seeing it. I think generally speaking, if you look at the TVL that is locked in a lot of these DeFi protocols, it's gone through the roof. And that's partially driven by the fact that there is very little oversight. There's very little KYC. And so people do like the decentralized aspect of it. The fact that a centralized exchange does carry with it risks. If it goes down, right? If it takes risks with your capital, they aren't insured. Generally speaking, they're not insured, right? Like even your money in your bank is only insured up until a certain point. So if they go down, there goes your money with it as well. With the decentralized world, it's a bit different, right? But there again, there are risks that come with that as well.
So, okay, let me ask you this. What are your thoughts on increased retail participation and market impact and more attention from regulators?
I think it's a good thing. I mean, again, it depends in which industry we're talking about. If you go to the traditional retail trading industry, there has been a huge boom, obviously, in retail trading, driven by what one would call, to a certain degree, disintermediated brokers like Robinhood, although they do rely on market makers as well. They have relationships with the likes of Citadel. They have empowered, to a certain degree, the masses to actually take control of their financial future and make a lot of gains without having to rely on asset managers and things like this, right? So I think that trend is definitely there as well.
All right, and to wrap up here, how about the drastic upswing of total value locked on DeFi protocols approaching just about $100 billion and counting? How does that impact the space, and what does it mean for investors?
Yeah, so I think there's a small buyer beware, caveat emptor that I would definitely like to flag here. So the TVL has rocketed, and it will continue to rocket, right? With Bitcoin hitting all-time highs, more capital, more wealth has been created in that space. But it is, of course, the interest rate differentials that are driving this frenzy into DeFi protocols. And what I mean by that is if you look at your traditional banks and savings products, right? Or even if you look at equity market returns that your fund manager will give you, they're kind of either negative all the way up to 5, 10%, maybe 15% in a good year gross, right? That's before hurdle rates kick in. And so if you look at DeFi, what's happening there is you're earning 7% a month, right? In certain instances, even 20, 30% a month. Of course, the risk is higher, but at this very moment, in this frenzied period, when you've had all this QE helicopter money that's been put into the system, the market is going to chase higher yield, right? And you're getting that with these DeFi protocols. So obviously the TVL has skyrocketed. It will continue to skyrocket. And partially, like I mentioned earlier, also is the KYC aspect, right? It's just quicker to move money into there. There's no KYC. But I think in answer to your question about regulation kicking in, that will change as well, right? So this is super normal, what we're seeing in the space. This is not something that's likely to be sustained. But it is definitely a warning to traditional finance that, look, it is not good enough to just pay your depositors 2% interest a year or 1% or real returns even negative. You're going to have to do a bit more, right? Because what's happening in crypto is unheard of.
Right. All right, Kay, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you so much for your time.